Welcome to the Expert Series from Selling Your Canadian Business. Our book lays out the expert team of advisors every Canadian business owner needs in their corner. This series brings those experts into the conversation, one at a time. Disclaimer: this series is for educational purposes only and is not professional advice. Always consult qualified professionals. Find our book and more resources at sellingyourcanadianbusiness.ca. Here is your host.
Hello, everyone. I'm David Prowse from the Shaughnessy Group, and this is another episode of the Expert Interview Series. This is our opportunity to interview the experts who help business owners grow and eventually exit their business. Today's guest is Wes Forgione. Wes is the founder of Forgione Deal and Corporate Counsel, a boutique M&A corporate law firm serving founders, operators, and business owners across the Greater Toronto area. Over his career, Wes has closed upwards of 400 M&A transactions with a near perfect close rate. Clients and referral partners know him for three things: being lightning fast, clear communication, and as a deal maker who finds solutions, not obstacles. He loves the mountains of BC, his wife and his two boys. He trains hard in the gym, and his goal is to compete in Muay Thai in the near future. Wes, thanks very much for joining us today.
Thank you very much, Dave. Pleasure to be here.
Great. Wes, tell us a little bit about yourself and how you got to where you are today.
Sure. So my name is Wes Forgione. I run Forgione Deal and Corporate Counsel. And when I practiced previously in British Columbia, I was a records officer for 400 companies. So that's kind of my frame of reference.
Yeah.
And my whole practice is built around one thing: helping business owners get their companies actually ready to sell and then getting the deal done when the time comes. As you mentioned, I've closed over 400 deals. So it's, that's a lot of war wounds that I've got, that I've learned from.
Mhm.
And what pulled me toward the specific focus is a pattern I kept seeing deal after deal. The legal side of the business is almost always the last thing an owner thinks about. And it's usually the thing that either lets a deal close smoothly or it blows it up at the worst possible moment. I got tired of watching good business owners lose leverage, lose money, and lose a deal entirely over things that could have been fixed years earlier. So, they're hard deals. These are hard deals to begin with. So I'm just always thinking of how can we make this smoother? How can we make this better? So that's what I do now. A client once called me their corporate quarterback, and it really stuck. I handle the core legal work directly, and I bring in the right specialists when the deal actually needs them, but the focus never moves off getting us to closed.
Yeah, excellent. Well, thanks very much. So let's say a business owner comes to you, they're within 5 years of a potential exit. What are some of the things that you're going to help them start thinking about?
The first thing is I want to look at their corporate minute book. I want to look at the minute book. I want to look at the share registers, the resolutions, whether the corporate structure actually reflects what's going on in the business. It sounds boring, but it's almost always it's if I'm on for a buyer, that's the first thing I need to see. Because if the corporate house is neglected, it's going to raise red flags for me, and I'm going to let my client know if that's neglected, what else is neglected. And next, I'm looking at key contracts, suppliers, leases, customer contracts, anything where there can be a change of control clause buried in it. Oftentimes owners, they're getting a contract for a supplier or a customer, and they're looking at the price, they're looking at the term, like, okay, I'm getting a good rate, I'm getting paid on time, but they're not looking at these things like, if you got a customer, let's say that's 50% of your revenue, and they can terminate the contract, either on like 30 days notice or on a change in control of the company, then a buyer's going to want a discount for that. That's a risk.
Yeah.
And then last, owner dependence is really important. I'm always looking at how dependent is this business on that owner, or does it have objective systems in place that, when the owner's gone, this thing is going to run like a dream. It's going to run like a beauty, because a buyer will pay a premium for that, and they will discount if the business is dependent on the owner.
For sure. Are there issues that, maybe a lot of business owners think are minor, but actually turn out to be pretty important?
As I mentioned, corporate minute books for sure. It's like I'm dealing with a couple of them right now that they were just kind of treated as like, oh yeah, it's just paperwork, don't worry about it. But as I said, buyers see it as a proxy for how careful you've been about everything else in the business. Customer concentration, and also employment contracts. That's a big one, because a lot of owners don't realize, if they either don't have employment contracts or they have poorly worded contracts. And why they're important is because a properly worded employment contract in Ontario can restrict a terminated employee to severance under the Employment Standards Act, which is much lower than under the common law. If you don't have
Yes.
the right contract, an employee, a terminated employee can claim severance under the common law, which can be substantially more expensive and a significant liability.
Yeah, and we've seen lots of situations like that where it can cause problems at the 11th hour. Now, I know you've created an exit audit on your website, and I recommend everybody go to check that out. It's a practical tool for owners. What are some of the biggest categories? Why don't you just walk us through some of the big categories?
Sure. It's hitting on a lot of the things that we've talked. Now, the purpose of this audit is, as I said, these owners have been building their widgets for so long and they haven't really put their minds to these things. So it's meant to be a checklist for them to go through, and like they're going to look at their corporate structure and governance. That's a really important one. Contracts and commercial relationships. Employment and people. Do they have these carefully written employment contracts? Another one is intellectual property. Along the way, they may have systems or things that they've contracted out that have been built for them. And were those contracts written in such a way that they own the intellectual property versus the contractor that's just licensing it to them?
Yeah,
Financials, tax, regulatory. We want to see clean books. Clean books is a beautiful thing. And
yeah,
owner dependence, that's another thing that it deals with.
yeah. And are there, like some of the common weak spots that you've seen so far from the people who have taken your assessment? Have you seen some trends?
Oh, minute books that haven't been touched in years. This is the single most common gap that I'm seeing. One I came across was in the company was about 10 years old. Early when the company launched, they had a key employee that they offered stock to in an employment contract. And but the stock, it was never actually issued. So it's like, okay, well, this is a problem for a buyer now because you have potentially another shareholder that's not on the books that we have to worry about. So
Mhm.
that was one thing that came up recently.
Yeah.
Yeah, and then contracts with vague or missing assignment language. How much the business runs through them personally. This isn't a single checkbox. It's a pattern across the audit. Owners consistently underestimate how dependent the business on them is on them, and then going through, they can be like, wow, this is I really need to start building in systems and bringing in key management to make this business more sellable.
Yeah. Now you've mentioned we talked a bit about the minute book before, and obviously it's something that people consider kind of boring, kind of mundane. It's probably the last thing they care about, but yet, like you said, it is something that's important, and because it really, I think, gets into optics, and for a buyer, they're going to assess a business, they're going to make their own risk assessment. So I think that's where the minute book really comes into play, is that if you see a messy minute book, there's probably other things behind the scenes that are maybe messy too.
100%, 100%. It signals neglect. It signals that you don't care about the compliance end of the business, about
Yeah.
you're focused on making revenue, but there's a lot more to keeping a stable business than just that.
Yeah. And if you like during the deals, like the minute book, like is it time consuming to try to get it up to get up to speed?
It depends. I mean, we can clean up a minute book in about a week. In
Yeah.
about a week or 2 weeks. I mean, if it's really bad, 2 weeks. And it also depends how have they missed their annual filings.
Yeah.
It depends how many dividend resolutions there are that haven't actually been, because every year when an owner pays dividends to themselves, they take money
Yeah.
out of the company.
Yeah.
Their accountant is going to send a dividend letter to their lawyer, and has that been done? Has that been documented?
Yeah.
Um, yeah, so it can take some time, but we can also do it in a pretty efficient manner.
Oh, that's excellent. So you mentioned when you set up these audits on your website, that a lot of these terms and questions that you've come up with really relate to battle wounds that you've had in the past. Because you mentioned you've done almost 400 deals, so you've seen lots of stuff. So maybe you kind of walk us through like some of those wounds, like that actually prompted you to set up this questionnaire in the first place.
So yeah, battle wounds. All right, here I love this part. The first one, and I really want anybody listening to really think about this. If you're a seller, um, whatever lawyer you're going to use on your end and who the buyer uses, you need to make sure that they are competent to handle M&A. These deals are hard, they're complicated. And if you have a generalist, your golf buddy lawyer who, he does a little bit of everything, he does a little bit of corporate, a little bit of estates, they're gonna create problems. They're gonna create problems with you and potentially collapse the deal. Like in one circumstance, I was on for a seller and there was a buyer's lawyer, and we were well underway into the contract, and he told his client that he believed he was paying too much for the business. And of course, which is like, whoa, 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 like that is not your expertise. Lawyers are not business valuators. They're not accountants. We should not be opining on price. But in that circumstance, the client heard this from their lawyer, and all of a sudden they've got credibility, right? So that all of a sudden the buyer starts getting cold feet. He's getting angry at his broker. He's like, why am I overpaying this? You said I was getting a good deal. And it almost blew the whole deal up. It was not good. The second change of control clause blows like a biggest customer. I had a business where there was one customer that was about 50% of revenue, and on paper, they had a change of control clause, basically saying, "Hey, seller, if you sell your business, we can terminate this contract, on 30 days notice." Or I don't remember exactly the notice period, but it was really easy, and that was a problem. That was a real problem because then you got to go back and get that renegotiated. Um, Another battle was that exactly that share issuance issue with that employee that was not actually kept in the cap table. That was a problem. We had to go back and get releases. And the employee didn't even work for the company. The employee was they'd been gone for like 5 or 6 years at that point. The seller didn't even know where they were, and we had to track them down and get a release so that they wouldn't claim an interest in the company and collapse the deal.
Yeah. Well, and you raised a good point about the lawyer and why it's important to hire an M&A experienced lawyer, because we've seen on our end doing deals where sometimes a generalist is involved, and they're probably very competent in whatever area that they normally deal with, probably corporate law, but the reality is that when you get into deals, if two people, generally they probably want to get that deal done. Uh, you know, Obviously they expect their lawyer to protect them, but at the same point in time, I think sometimes if the lawyer does not have the experience that maybe they should have in M&A, there's a lot of problems that come up that really aren't as relevant to closing the deal as it should be, or maybe they're going to miss something that actually probably should maybe give everybody some pause, and they're going to skip over it. So, I mean, maybe just reiterate your point about like why that's important.
Yeah, I mean the biggest thing that I can see is, as I mentioned earlier, these deals are very hard. They're difficult deals. So if you're a seller that is in the process of this, just get ready for that. And I don't say that to scare you. I'm saying that to prepare you. And there's going to be obstacles that are going to come up, and it's really important. A good M&A counsel, like I had a more recent broker come to me and say, "We've got this deal. I'm acting for a seller. We need a pit bull." And I said, "No, no, no. You do not need a pit bull. A good M&A counsel work collaboratively together with the brokers, with the accountants, because these deals are hard. And the best way to get them across the finish line is to have experienced counsel that all works together. This is not an adversarial relationship. If you have a lawyer that's going to turn this into an adversarial relationship, you're going to kill your deal. Like that's really it."
Yeah, for sure. So, we talked about, contracts are really important when it comes to M&A, and sometimes we could have a share sale, we could have an asset sale. I mean, the most important contracts, we mentioned them: customer contracts, vendor contracts, employee contracts. And then we get into issues about, do they need to be assigned? Do certain contracts need to be, terminated? Are there change of control clauses? So obviously there's a whole bunch of issues there when it comes to your contracts and getting through, getting the deal done. So why don't you talk to us a little bit about some of those issues?
Sure. I've got four that come to mind. In the first circumstance, the contract is entirely silent on the issue. It doesn't have any termination provisions.
Yeah.
And people would think, okay, that's safe, but it's not, because if there's no termination provisions, it means there's no rules with respect to termination. It can be terminated at any time. There's no break fee, there's no notice period, there's no nothing. So if your contracts are silent on assignment or termination, then that's a problem. Another one we see often is consent required. So like the individual, let's say your customer, they'd have to give their consent, or your landlord will have to give their consent to the transfer of ownership of your company. So if you do see consent required clauses, you want to get on that right away with whoever's the individual that needs to give that consent, because you're going to need to get it. There we see automatic termination on change of control. This is obviously a dangerous one and needs to be amended if you're a seller. And then last, you see termination for convenience, which is like you look at the notice period. They can just terminate on 30 days notice, 90 days notice for any reason whatsoever.
Yeah. And do you think then that this is something that should be addressed during like the planning stages before you've even listed your business, or is this something that you just have to wait till due diligence?
Well, I mean, I think if you're a seller, you just got to think about it from the buyer's perspective, because they're going to see it. They're going to look at your agreements, they're going to look at your contracts, and if you're buying a business and 50% of the revenue is entirely dependent on this one client, one customer who will either automatically terminate, the contract will automatically terminate on the deal closing, or they can terminate easily, that's going to give me pause as a buyer and be like, whoa, like this is a real risk for me. Um, I need to either, get a discount, or we need a holdback, or, we need to keep you, we're going to have to adjust your earnout so that it's
Yeah.
a longer period so that we can really get that relationship transitioned.
Yeah. So one of the other assessments that you set up was owner dependence audit. And I know from being a former exit planner and still even dealing with it today, that owner independence from their business is a critical factor. So, from your perspective, from a legal perspective, I mean, how does owner dependence play into the whole transaction?
Because a buyer isn't just buying a business, they're buying a business that has to survive you leaving. If everything runs through you personally as the owner, the client relationships, the vendor relationships, the intellectual know-how, then the buyer's like, what am I buying here? Like it's if
Yeah.
you leave and everybody leaves with you, then what am I buying? I'm not buying anything, and I'm certainly not paying a premium for it.
Yeah. And do you think, like I would think from service-based businesses are probably going to be the most prone to that type of issue?
For sure. Absolutely. Absolutely.
Yeah.
Because of those relationships directly with these critical customers and suppliers and vendors too. And we talk about customers a lot, but if your business is dependent on certain materials or certain services that are coming from an external contractor, and the business doesn't function without those, you got to make sure that's bulletproof. You got to make sure.
Yeah. And I know when I've dealt with service-based businesses in the past, a lot of B2B businesses, that, we call it personal goodwill, but I know that's a particular issue that when we're in the planning stages, we try to make an assessment about, to what degree is that business really, you know, uh, tied to the owner, and especially if the owner is like the owner's like the sole rainmaker. I mean, that's a potential problem, or the systems and processes are all setting up in the owner's head. That becomes a real big issue.
Yeah, absolutely. Completely agree with you.
So let's just say somebody has, they've taken your assessment, your owner dependent assessment. They've told you, hey, I'm 24 months away from a potential exit. They didn't score very well on your assessment. What kind of advice would you give them?
Um, Now we're talking about the owner dependence
The owner
assessment
owner
now.
dependence, yeah.
Yeah, I mean, I'd say, it's going to be entirely dependent on the results of their assessment. But I'd say the three kind of key practical steps that they can take, in addition to if they've got additional issues to deal with. But the first is delegating signing and approval of authority formally, whether that's through a power of attorney, whether that's through a resolution by the board, giving certain, management people delegate the authority to actually run the business and do the things that need to be done. Second, documenting what's only in your head. Like if there's certain things that like you are so critical to the business and you have the know-how and nobody else does, you got to make sure that's clearly documented and down on paper. Because again, if you think about it from a buyer's perspective, if they're buying the business and you've got this certain know-how that's critical, and if it leaves with you, then that's a huge problem. Last, put a second name on your key relationships. Go through your Rolodex, figure out who your key suppliers, your customers, etc. are. Go to your business, think about who in management could step in for you, and then start bringing them in, establishing those relationships, and then it's just going to look so much more attractive to a buyer if you want to make yourself dispensable. It's
Yeah.
kind of counterintuitive because you build the business making yourself just indispensable, but you want to make yourself completely dispensable and unneeded.
Yeah. Yeah. And that's a great point because, I think if you can bring some other contact within your organization that they're familiar with. So when the transaction happens and, we don't know what your involvement's going to be with the business. In many cases, it's very limited, maybe nothing at all. So if you've already had somebody else within the organization that they're familiar with, that transition can be a little bit more seamless from the perception of the customer or the vendor. And I think that's really important.
100% agree. 100% agree.
So one of the things that I know it's a work in progress right now, but I'm very excited when you told me about it was this, you're working on what's called a quality of legal report that you're going to start offering those services. And for those in the audience, you might be familiar with quality of earnings reports, which relate to financials. So obviously this has a legal perspective. Why don't you tell us a little bit about what your vision is for this quality of legal report?
Sure. So, I mean, this was born out, a lot, and I think one way that I distinguish myself from other lawyers is I don't think of myself as a lawyer primarily. I'm a businessman who happens to practice law. What does
Yeah.
that mean? That means I've had my own businesses in the past. I've had startups that have worked, startups that have failed,
Mhm.
and as I go through this process, these deals are difficult. These M&A deals are difficult. And I'm always, from that businessman perspective, I'm thinking about how can we make this better? How can we make it smoother? So, what if we could use this audit and then go more in depth with all the supporting documentation and then build this quality of legal report that you as seller can then hand to a buyer and say, look, we're good. Take this to your lawyer. Here's all the evidence. It's going to cut down on DD substantially because everything's going to be beautifully outlined and clear. Everything that you need to know, everything you'd want to know, it's going to be in this report. And it's just, let's get the deal done. Let's make it smoother.
Yeah. And I think we've seen a big growth in sell side quality of earnings reports. So obviously, this report is meant to be performed on the sell side to hand to the prospective buyer. Is that correct?
Exactly. Exactly. And it's really just anticipating, the buyers don't want to pay a premium. They're going to look for reasons that they can get your business for less than it's worth.
Yeah.
And this is like, I'm not going to say it's bulletproof, nobody can guarantee anything, but the idea is that to create this very strong document that shows, hey, here's all the points you need to know, and here's where we're strong.
Yeah. Well, I'm enthusiastic about it because I know sell side we're a big proponent of sell side quality of earnings reports. I mean, we would be a big proponent of this as well because I think at the end of the day, I always think that any sort of pre-due diligence work you can do, which is kind of what this is, helps to make that due diligence process a lot smoother. It helps I think from a buyer perspective, it helps reduce their perceived risk of the business. And we just talked about what the impact of a messy minute book is. Well, the opposite is also true, where if you come across very organized, you got your stuff together. Well, that's something I think a buyer can really appreciate,
100%. 100%.
and
And
they'll
I
be
mean,
willing to
just
pay for it.
100%. You're making their life easier. At the end of the day, our buyers buying their business because they think they're going to be able to profit from it. That's it. And they can only profit from it if earnings are good, yes, but also if they don't have headaches and problems. And that's the point of the report, is to say, hey, we're looking good.
Wes, thank you very much for joining us today. This has been a very interesting and enlightening conversation. Looking forward to that quality of legal report once it's ready to go to out to market. Everybody out there, you'll have some details on how you can contact Wes. I would go to his website. If you're a business owner, go run through his audit checklist for the owner dependence and the business readiness. And we'll see you on the next episode. Thanks very much, Wes, for joining us. Appreciate it.
It was an absolute pleasure.
That concludes this episode of the Expert Series from Selling Your Canadian Business. This conversation is for educational purposes only and is not professional advice. Always consult qualified professionals. Click on any of the additional resources on screen or visit sellingyourcanadianbusiness.ca. Thank you for joining us.